Welcome to the Trap Hagen webcast. My name is Chris Fundora, and today I want to talk about retirement changes that have occurred under the CARES Act. And so the CARES Act is legislation that was approved and processed in March and added a lot of stimulus to our economy, both on a personal or individual level as well as a corporate level. And so there's been a lot of headlines, a lot of data that has come out regarding that, really a lot of facets to the CARES Act. And so what I want to focus on today is specifically how the CARES Act has made changes or adjustments or opened up opportunities in our retirement accounts. Just before I jump into that, I do want to talk about for a moment the economic impact payments. And so if you qualify for this economic impact payment, those are the $1,200 stimulus payments. So it's $1,200 for an individual. If I am married filing jointly, that could be $2,400 if I qualify. If I have dependents, there's an additional $500 per dependent under age 17. And so that gets sent to you if you qualify based on your income. So to receive the full benefit, if I'm filing single, it's about $75,000. If I'm filing married, filing jointly, it's about $150,000. And then head of household, it's about $112,000. It's in between those two numbers. And so if I do qualify based on my income for the full amount, I will receive that, okay? If I make above those thresholds, it phases out. So I will still receive a benefit up to a certain point. Technically, the way that the math works is that for every $100 that you are over that limit or the threshold, then your benefit gets reduced by $5. So you can calculate the terms on that to determine what you would receive. But if you haven't received that payment yet, what you'll want to do is go onto the IRS.gov website, and they've created a portal similar to the Where's My Refund portal. And so if you go to the website, you can scroll down on the left-hand side. There's a section that says Economic Impact Payments. You can click there, and then there's a button to check your status. When you do that, if there's any reason why they haven't been able to send it to you, maybe your bank account information needs to be updated or something needs to get clarified in terms of your tax return, it'll actually ask you that information via the portal. You can update that there, and then you can periodically check on it as they update it every day to see the status of that payment. So take that into consideration if you're wondering where your payment is and you haven't received it yet. That's the avenue to go. But I really want to focus on the retirement account. So specifically, we're going to talk about hardship withdrawals, early withdrawals, in-service distributions, really understanding the terminology and what is the difference between each of those. We're also going to talk about loan provisions in corporate retirement plans. So when I say a corporate retirement plan, I'm referring to a 401k or 403b or 457, essentially a company-sponsored retirement plan. Okay, and we're also going to talk about required minimum distributions, what's changed, and some strategies that we could potentially implement in that regard. So going with hardship withdrawals, I want to look at it through a couple different lenses. First, there was actually legislation that came out before the CARES Act called the Secure Act, and that came through in December. That was approved and signed into law in December, and a lot of it went into effect now in 2020. So I want to look through it through that lens. I want to compare it via the CARES Act and the changes that have happened there. And then I want to look at the tax implications of how this all works. So what exactly is a hardship withdrawal? A hardship withdrawal technically is only regarding my corporate retirement plan. Okay, not my IRA. My IRA doesn't need a hardship withdrawal. And I'll explain that in a moment. That's just a technical aspect, but you see that a lot, so I don't want you to get confused. A hardship withdrawal is for my corporate retirement plan. And in there, basically the way that it works is that if I qualify based on need, and this is looking at it via the Secure Act. Let's do that first. If I qualify based on a need, then I can take funds out of my retirement account to meet that need. So the IRS defines that as a removal of funds from your retirement account to meet a quote-unquote immediate and heavy financial need. So what does that qualify as? That's certain medical expenses, that's educational expenses. So that could be college for one of your children. There's funeral expenses for a family member, primary residence, which includes a purchase or repair or preventing foreclosure. And then what's been added under the Secure Act is disaster events. So if FEMA designates our area as a disaster zone and we've been impacted by that, either where we live or where we work, then that can qualify for a hardship withdrawal and actually cover lost wages. So all different avenues to get those funds. And under the Secure Act, so prior to 2020, the way that it worked is I would have to certify that I meet those requirements to my plan sponsor, and then which is HR or the business owner themselves. And then if it was an option in my plan, not every plan has a hardship withdrawal feature, but if it was, and they approved it, then I could take this distribution. Now, the amount that I could take has to be the amount of my need. So if I need $50,000, I can only take $50,000. That's how it worked prior to 2020. And then in terms of the tax effect, when I take those funds out, one, it's irrevocable, and two, I have to pay tax. So irrevocable in the sense that I cannot put those funds back into a 401k or an IRA. I can't do a rollover. I've literally taken them out. I have to use them, and I'm paying federal and state tax, local tax if applicable. And also, if I'm under the age of 59 and a half, there was a 10% penalty that I had to pay as well. So in certain situations, that could be 50% tax plus penalty on my distribution. And so I'm really drawing down on my retirement to meet this need. Part of the requirements used to be that this was actually a last resort. So I had to look at a loan first. I had to look at every other option essentially before I came to this point of taking a hardship withdrawal. So that was the specifications of that under the Secure Act, and will still be in effect once we get back to 2021 unless things get extended. But how does it look today? How does it look in 2020 under the CARES Act? I want to make a clarification here because there's a lot of misnomer going on. And so a hardship withdrawal is one thing. What the CARES Act has done is created a different type of distribution, which is called the Coronavirus-Related Distribution, or CRD, is how I'm going to refer to it for the rest of our time together. And so on a CRD, this is completely separate, and the way that that works is I can actually take a distribution of not only my 401k, but this also includes IRAs. So if I have a SEP IRA, a traditional IRA, a rollover IRA, those would all qualify under the CRD. And in that regard, I could take out $100,000 total. That's the maximum. Now, how do I qualify? It's very broad, given the circumstances that we're in. So qualification is either that I've had a medical impact where I've been diagnosed or a family member or dependent has been diagnosed with COVID-19, or I'm facing adverse financial consequences. So that includes reduced hours, furlough. It's also including if I have to stay home to take care of my children because school is still closed. All of those come into consideration and would allow for me to take advantage of the CRD. So what's also changed is under this section here where we're looking at tax implications. So in tax implications, even if I'm under 59 and a half and I take this distribution under the CRD, the 10% penalty has been waived. Okay, so there is no longer a 10% penalty on the funds that I take out. There's still federal and state tax due, and again, local if appropriate. But this, instead of being due this year, it's actually spread out over a 3-year time period. So what I said in the hardship withdrawal, we couldn't return it, it was irrevocable. That's not the case with the CRD. You can actually return those funds either to the IRA or to your 401k. Now, let's say towards the end of that third year, I treat it as essentially a loan and I return the $100,000 back into my account. Everything has sort of leveled out and rectified, and I've returned those funds. I don't owe any tax. It's a return of the amount. And so really the only impact that I've had in that case is those funds have been out of the market. Right? I literally have taken them out. They're no longer participating. And so my remaining balance, if any, is what is left to participate in the market. Now, an important consideration about that is the way our portfolios are invested. Right? You really need to consider that. If you're taking a distribution from a 401k, those funds could come out across the board. That may not be the best thing. Okay, you may want to have that directed more from certain assets or asset classes. Like, for example, if you have a heavy weighting to fixed income, let's say, or cash, that might be a space where you want to take that distribution from, because that equity exposure is going to give you that potential for recovery over time. So how does hardship withdrawal differ from an early distribution or in-service distribution? We've heard these terms before. They get very confusing and they're used interchangeably even though they really shouldn't be. So we covered hardship, we covered CRD. What's an early distribution? Okay, so the early distribution, that's regarding an IRA. Okay, so what I said earlier, a hardship distribution really doesn't apply to an IRA because since it's my account, my individual retirement arrangement, I can take those funds out whenever I want, right? That is my election. Now, there's a cost for that. And if I take funds out of, let's just say, a traditional IRA, I have to pay tax still. And if I'm under 59.5, I have to pay the penalty as well, which is still 10%. So in that case, similar in terms of tax and penalty to a hardship distribution, what people are referring to when they use that language interchangeably is that there are ways to get out of the 10% penalty. Okay, there are certain exemptions that you'll still have to pay federal and state tax, but I won't have to pay the 10% penalty. And so some of those are medical expenses while unemployed, if I have permanent disability, higher education, if I'm in an inherited IRA, I have to take those. I don't have to pay a penalty on it because I'm required to take it out. First-time home buyer, and then a 72T election. So we can always go into more detail about that, but essentially a 72T election was if I was in a position where I needed to take funds out of an IRA, but I wasn't 59.5 yet, I could take funds out and avoid the 10% penalty, but the rule was that I would have to take the same amount, right, an equal distribution amount for the greater of 5 years or until I reach 59.5. So I would have to kind of plan that out to say, okay, if I need X amount of dollars, I need to know that I'm going to be required. If I take it today, I have to take the same amount the next year and the following year and the following year thereafter. So that's a 72T election. For this conversation, it's not really applicable because of the CRD and what that's been doing and kind of the alleviation that that's provided in terms of getting access to your retirement funds if you need it. So that's an early distribution. That's for IRAs. And what's an in-service distribution? So an in-service distribution is I am a part of a 401k plan. That plan document allows for me to take money out while I'm still working. Very few plans actually allow for this. Some do, though. They allow for you to take funds out while you're working. And so same idea. I can take funds out, right? Kind of like an early distribution. Same concept. I'm paying penalty and I'm paying tax. And in this case, where we are in 2020, like I said, all of these would kind of flow through that CRD because that would be the most advantageous way to gain access. But I do want to provide clarity. One thing that's still going on today that I want you to be aware of is in these corporate retirement plans, like I said, 401k, 403b, 457, whichever it may be, there's an age 55 rule typically that's applied. And so what that means is if I separate from service, I'm no longer working for that company, and I'm 55 or older, I can actually take distributions from that retirement plan, and I don't have to pay the 10% penalty. Okay, it's a special feature. Now, I have to leave those funds in that specific 401k plan, just 401k as an example. I have to leave it in that specific plan. So if I was working for company A, I'm no longer working there, I'm working for company B, and I'm 56 years old, I'm going to want to leave those funds in company A, hypothetically, if I need them, because then I can take a distribution without having to have an exemption, and I missed that 10% penalty, which could be good. Now, it doesn't always apply, right? It's not always the best option to leave the funds in there. If our fund options aren't great or we don't need to do that, or particularly in this season where we have other avenues to get access, it may not be applicable. But under normal circumstances in 2019, and I imagine as we return in 2021, that age 55 rule will be something to consider once again, okay? And once you make that election, then that is irrevocable as well. So if you do a rollover out of that and you go from company A to company B, you lose that ability, Okay, so keep that in mind. That's always something that we can discuss more if that's applicable to you and if that makes sense. So we covered the distributions. Okay, now for loan provision. So loans, again, this is not regarding IRAs because I can't take a loan against my IRA. This is regarding my corporate retirement plan. So if my 401k allows for loans, the way that the rule used to read is that I could take the lesser of 50% of my account value up to $50,000. So same example, I have $100,000 in my 401k. I could take a loan of $50,000. If I have $50,000 in my 401k, I could take a loan of $25,000. Now, those funds have to be repaid, and typically, depending on what we use it for, but typically that repayment period is over 5 years. So at a minimum, I have to make a quarterly payment, or I can do it via payroll every 2 weeks or semi-annually, however that works. And I can make that payment back. Now, keep in mind, you took those funds out, you're going to pay it back with after-tax dollars. Okay, you don't get to pay it back with pre-tax dollars. So keep that in mind. You take the loan, you have to pay it back via payroll, and you'll pay that with after-tax dollars. Some of the nice things about a loan relative to a distribution is that, one, it's not taxable. Okay, there's no penalty either. Two, not reported to a credit agency. So if I do take a loan, non-reportable, and I'm not paying tax on it, but I do have to pay it back over that 5-year time period via that, at least on a quarterly basis. Okay. What's happened with the CARES Act is I actually don't have to make those loan repayments until next year, until 2021. And there's been some adjustments where instead of that 50,000 or 50% rule, they've doubled that. So now I can take the lesser of 100% of my vested balance up to $100,000. So if I have $100,000 in my 401k, I can literally take a loan for $100,000. If I have $500,000 in my 401k or $1 million or whatever the number may be, I am capped at $100,000. So again, you have access to that if it's in the plan document. You are allowed to take that loan to all the features that I discussed. So that's why it's a little bit more of a simple process to get access to those funds via a loan rather than a distribution. Now the difference really, so you might be thinking, well, what's the difference between the CRD and a loan? And really, if your intent is to return the money you take out via the CRD, and let's say you do that at the end of 3 years, really the only difference at that point is that I'm either paying it back in 3 years or in 5 via the loan. And my payment is either I can do it in a lump sum via the CRD, or I have to do it at least on a quarterly basis via the loan. So really repayment is the differential at this point. So again, all of those things are to consider, and they may only be here for 2020. So that could change, and now we go back to 2021 and things could revert to how they once operated. So it's important to, if I need access to funds, it's really important to have a conversation, right? Speak to the team, speak to the advisor that you work with, and we'll advise you on what's the best course of action, right? This is why we run financial plans, to determine what is best next, right? If I need funds, what avenue should I pursue? You know, if I was a sole proprietor and I need access, I may want to file for the PPP, and that's a conversation we may cover in another webcast. But there's a lot of options, a lot of different resources out there, and so it's our role and our responsibility as your fiduciaries to support you and guide you and care for you in that regard in terms of providing guidance and counsel. So let's have that conversation before you make any of these elections, if appropriate. But I do want to give you this background. I do want to give you this information because it's coming up, and I think there's some confusion with the way that it's been reported. So we covered the loans, we covered the distributions. Now, for required minimum distributions, okay, 2 changes have really occurred. Under the Secure Act, which I referenced earlier, and that's the legislation that was passed in December, the age that I have to start taking my RMD has been delayed. So basically, if I turned 70 and a half before the end of 2019, I'm still operating under the old rules, right? 70 and a half is my RMD age. If I didn't turn 70 and a half by the end of 2019, then my new RMD age is 72. So With that, I get a little extra time before I'm required to make distributions. Now, you can make those distributions if you need to, right? If it's used to cover your cost of living, you certainly can get access to it. There's no penalty because we're over 59 and a half and we're paying tax on the distribution, which is normal. The benefit really is that if I don't necessarily need the funds or I don't need the entire RMD amount, I'm not required to start taking it until 72. So it gave me a little more time for those funds to stay in my retirement account and get income and appreciation through those years. So that's under the Secure Act. It also resulted in the elimination of the stretch IRA provision. I'm going to talk about that on the next page in a little more detail. But when we look at it under the lens of the CARES Act, what's happened is that I actually don't have to take an RMD at all for 2020. Okay, it's been postponed. So if I now qualify because I'm 72, or I already qualified because I'm 70 and a half, I do not have to take an RMD. If I'm a business owner with over 5% holding in the company or ownership in the company, old rule is I had to take an RMD. That's not the case. It is postponed for 2020. Okay. Can you still take it? Absolutely. Do you have to? No. If you've already taken some funds out because maybe you do it on a quarterly distribution or monthly, you can return some of those potentially back into your account. And so you don't have to pay the tax, right? That's really the benefit. I'm not paying tax on those funds if I don't need to use them. And it also opens up some other avenues that we can consider in terms of strategy. So I want to go through that. And one of them is that in this case, this might be a year where I don't want to take the RMD because it'll actually qualify me for some state programs, right? But depending on my income. So if the RMD put me over this income threshold and I didn't qualify for some of those plans previously, I might be able to qualify now. One example of that is the pension exclusion in New Jersey. So if I'm a New Jersey resident, and let's just say for an example, I'm married filing jointly, then if I'm making $100,000 or less, I do not pay tax in New Jersey. So specifically, that $100,000 number is excluding my Social Security income. So if I'm receiving my pension, my other sources of income, and that's $100,000 or less, I'm not paying tax in New Jersey, which saves me about $3,000 in taxes per year. Now, it is a cliff. So if I make $100,001, I do not qualify and I have to pay tax. So that's why in this particular year for 2020, we might want to look at the RMD and if it makes sense to hold back the full amount or a partial and potentially qualify for this program and get that benefit. So really important to consider those, and that's something that we're doing. We're running projections, tax projections, to really determine what's the best course of action for you. And that's a conversation that we'll have and we'll look at and we'll determine if that makes the most sense versus taking the distribution or partial distribution. That's one avenue. And that might be a reason why we don't want to take an RMD. A potential reason why we might want to take funds out is to run a strategy called Roth conversions. Okay, so this is really important, and I'm going to explain how that stretch IRA provision comes into effect also very briefly. But on the Roth conversions, okay, the way that works is I can take money out of my, let's just say, traditional IRA for this example. I have to pay tax like normal, state and federal. And then I can take those funds and put them into a Roth IRA. So what's the benefit there? I've taken those funds, all right, maybe I take a smaller amount, or depending on what my tax bracket is, maybe I take the full amount that would have been RMD, or maybe even more. I'm taking those funds out. I'm paying a low tax bracket rate. Okay, if my bracket's low, and we'll do that analysis, that's an important analysis to calculate. If that makes sense, and I'm really under 15, 20% rate, then I'm taking those funds out. I'm paying a very low tax rate on it. I'm moving it into the Roth IRA, and now all of the growth on those funds going forward is tax-free for life. Okay. Also, a Roth IRA does not have an RMD provision. So I can move those funds in, and it's not that I have to take an RMD again. It doesn't qualify. So I'm getting tax-free growth, and the way that this ties into that stretch provision, what is a stretch IRA? So again, old rules was that let's say that I have my retirement assets, my wife and I pass, it goes on to our beneficiaries. It used to be that they could stretch it out for their entire life. Okay. That means if someone receives it and they're, let's say, 30 years old, they can literally take distributions. It gets calculated over their lifetime per an IRS table. And so that was very small incremental distributions over their life. What's happened as part of the Secure Act is that stretch IRA, right, stretching over the beneficiary's life, has been removed. So instead, I have to take, as a beneficiary, all of those funds out of the IRA by the end of the 10th year. Certain math, you could say by the end of the 11th year, but for simplicity, let's just say by the end of the 10th year, I have to take all of those funds out of the IRA account, and I'm paying tax on it. So if your beneficiaries are in a higher tax bracket than you, then you're going to pass on those funds to them. And this is really a part of legacy planning. If I am building into my financial plan that I want to leave assets to the next generation, as I do that, they're going to have to take those distributions over a decade, which is going to be larger materially, and they're going to have to pay the tax. Most likely, they're in a higher tax bracket than we are in retirement. So what is this? How does this all tie together? If I'm doing Roth conversions, I'm paying the tax today at a lower tax bracket. I'm getting it into the Roth IRA, and we can see from that graphic on the right, IRA distribution, pay taxes at a lower bracket, deposit into the Roth IRA, and then if I use that, right, as a wealth transfer tool, I give that to my beneficiaries. Not only does it grow tax-free for that 10-year period of time, but then when they take the funds out, tax has already been paid. And all of the growth is tax-free, right? That's part of the rule. So then they can take those funds out and literally zero taxes due. So you just done a very effective, not only wealth transfer strategy, but also tax strategy and legacy planning strategy. So very important to consider, and this might be a year that we want to do that, because normally we have to take an RMD and maybe we use some of that. There's certain circumstances that come up, but this year in 2020, there's additional flexibility. So it's an option. It's something we can consider. We can run that analysis as we kind of navigate through the year and see what our income looks like. If we're on a fixed income, we can really run that analysis now and start making some of those adjustments. So again, powerful tools, powerful resources that are available to us under the CARES Act. So really in this time frame, it's looking at the tools and resources that we have and deciding what is best, what's most appropriate for us to use in our personal financial plans. And so I hope that this is beneficial to you. I hope that you've gleaned some insight from there. If you have any questions, please reach out to a member of the Traphagen team, or you can always contact me directly. You can email me at christopher@tfgllc.com. And thank you for attending this webcast. We are excited to continue this series, and so we'll continue with subsequent videos on different topics of value to you and your financial plan. So again, please feel free to reach out if you have any questions. All the best and stay healthy to you and your family. Thank you.